Bad financial news doesn't seem to stop coming these days. The compounding effects of the health crisis, the Russian aggression on Ukraine, broken supply chains, soaring inflation, rising interest rates, and a chaotic commodity market are threatening to provoke what some investors are calling a bone-dry recession and a full-scale stock market crash. The global economy and the financial sector are recording massive losses as conditions continue to deteriorate by the day. A widespread meltdown is on the horizon, and things could run off the track sooner than most people think. That's why today we have compiled warnings, indicators, and recent data shared by Wall Street's top strategists that expose the dire state of the global economy and financial markets and explain why a huge downturn is ahead. But before checking this list, don't forget to leave a thumbs up, subscribe to our channel so you don't miss our future videos. Here are 15 financial facts that just might scare the living daylights out of you. 1. According to Business Insider, Wall Street just issued its first official recession and stock market crash warning amid rising interest rates as the Fed starts to roll back its bond purchasing program. All major Wall Street banks are predicting a significant decline in the months ahead and all the way into 2023. 2. On Tuesday, Deutsche Bank analysts forecasted the S&P 500 to crash an additional 20%, pushing Wall Street to a bear market right before the U.S. falls into recession. The analysts believe that this view will eventually become a consensus. 3. For Morgan Stanley, this is already a bear market, and the latest gains were part of a bear market rally that typically occurs before more losses follow. However, according to the firm's chief equity strategist Mike Wilson, that bear market rally is over, and as the economy slows down, now it's time for a series of corrections. 4. Meanwhile, Goldman Sachs economists predict a dramatic economic slump in 2022. They expect GDP to collapse from 5.7% last year to 1.9% this year. They also highlighted that there's a 35% chance of a recession unfolding in the United States in the months ahead. 5. On the same note, Bank of America's Michael Hartnett wrote in a note released on Friday that the inflation shock is worsening, while the rates shock is just beginning, and a recession shock coming. The strategist highlighted that some overlooked factors such as food inflation protests in developing nations are likely to have a much bigger financial impact on global growth than traders are pricing in for. Social instability in emerging markets equals weaker growth, he wrote. Inflation always precedes recessions, and the last dominoes to drop in terms of recession expectations are higher yields, but a steeper yield curve, as well as a weaker dollar and lower consumer spending. It turns out that we have all of that in today's financial markets. 6. A major red flag for financial markets is the dramatic moves in the U.S. Treasury bond market. Last week, the 10-year Treasury yield surged to 2.557% a year. At the end of 2021, it hovered around 1.5%, meaning that the yield on this benchmark bond has jumped by almost a full percentage point in the first 4 months of 2022. Now, according to historic patterns, this also means that a seismic shift is happening. In the past, it was a signal that share prices were about to fall. With rising interest rates and rampant inflation impacting economic growth, investors are considering this bond rout as a warning sign of the next recession and stock market meltdown. 7. The Fed has caused enormous distortions in the economy and inflated an everything bubble over the past 2 years, but the situation is rapidly reaching a breaking point. That's why former U.S. Representative and 40-year Wall Street veteran David Stockman is sounding the alarm about a stock market crash of biblical proportions. Whether it wants to or not, the Fed will crash the stock market. They're going to have no choice but to throw on the brakes much harder than the market is expecting, much harder than they would like to do, or maybe even intend at the moment. But there is no way around it, Stockman argues. So the market will struggle with a Fed that turns out not to be their friend. It's like time and time again, people think the worst is over, buy the dip, and make a lot of money, only to be disappointed. I think the most important thing right now is to stay out of the casino, he cautioned, adding that the bond market is vastly, massively overvalued. As a result, the price of bonds will drop dramatically, and people will be shocked by how much you can lose in allegedly safe sovereign debt. The stock market is even more dangerous, and it's entirely because of these artificially low, ultra-low interest rates. So now we're starting to move into the realm of reality, let's say normalcy, as interest rates come back up, and I think they got a long way yet to go. If you're going to be in the stock market, be on the short side, the insider continued, noting that the market may lose up to 60% of its value before the year's end. 8. According to Bloomberg, the former president of the powerful New York Fed, William Dudley, says that the central bank will not be able to tackle inflation that's running at a 40-year high without making investors suffer. It's hard to know how much the U.S. Federal Reserve will need to do to get inflation under control, but one thing is certain. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far, Dudley warned. He also noted that the Fed isn't likely to ride to the rescue in the event of heavy losses in financial markets. 9. John Hussman, a market veteran who called the 2000 and 2007 crashes, says that stock returns are set to hit the lowest level since the Great Depression. By analyzing the implied 12-year returns of the market given current valuations, Hussman showed that the future of stocks is extremely bleak. Regardless of which measure you choose, you'll find that the estimated 12-year average annual total return for the S&P 500 is negative based on the current level of valuations relative to their historical norms. The only debate is how negative, he said. The president of the Hussman Investment Trust also said that investing in this environment mostly amounts to baseless gambling. 10. Market strategist and financial advisor Harry Dent is alerting that a wide-reaching global stock market crash of humongous proportions has already begun. The financial expert who correctly predicted Japan's 1989 bubble bust and recession, the dot-com crash, and the populist wave that brought Donald Trump the U.S. presidency in 2016, argued that the Russia and Ukraine crisis are mere catalysts of a meltdown that was already set to occur. Putin is just a trigger, so is inflation. They're only symptoms. The cause will be the biggest bubble in history, and bubbles do only one thing: burst. The biggest issue is that we have the greatest stock market and financial asset bubbles in everything that people invest in, he said, adding that it will be the biggest crash in our lifetime. Stocks will go down 89% to 90%. It will be global. Stocks and financial assets, particularly real estate, won't come back next year, not in 2 years, not in 5 years, not for decades. 11. Elite Wall Street investors are warning that the Russia and Ukraine conflict will trigger widespread economic chaos and a bone-crushing recession all over the globe. According to Business Insider's columnist Lynette Lopez, who talked to top investors on the condition of anonymity so they could speak candidly about where the market is headed, a consensus has indeed emerged. Russia's invasion of Ukraine has kicked their prediction for a stock market washout into hyperdrive. The murky global economic picture, clouded by supply-driven inflation pressures, is now even more complex and uncertain, and the shifts that turned some of the market's high-flying winners into losers are only becoming more pronounced, Lopez reported. 12. Investors are becoming increasingly more risk-averse and selling off the stocks of companies that relied on cheap debt to fuel speculative growth, especially in the tech sector. It is known that the tech bubble has started to burst in November 2021, and since then, investors have been walking away en masse from risky assets, leading a series of high-flying stocks to fall back to earth. Amongst them, discount mobile commerce app Wish has seen stocks go as high as $32.85, but now it's trading at $1.99. And that's more than 90% below its intraday 52-week high from almost a year ago. Moreover, e-commerce company Stitch Fix, which more than doubled in value in 2020, has been on a downward trajectory since 2021. Stocks are down by 85% from a year ago, the 52-week high, and over 90% from a record a couple of months earlier. Interactive fitness platform Peloton has witnessed a 35% drop in a single session as the bubble started to collapse last year, and reports on subscription revenue, digital subscribers, and gross margin all fell short of investors' expectations. In January, Peloton announced it was temporarily halting production of its connected fitness products, sending shares down by an additional 24%. A month later, CEO John Foley said he would step down and the company would lay off 20% of its workforce. All of these factors led the stock to crash by 83% from its 52-week high. 13. Robinhood, the trading platform with the fastest growth in the past 2 years, has seen its stock shares collapse since the peak of the bubble, which resulted in massive losses for retail investors. In August 2021, Robinhood hit a record of $80 per share. Today, it stands at just $12 per share. That accounts for a loss of $3.7 billion, and its decline is contributing to the implosion of several other sectors on Wall Street. 14. Wealthy investors already know that a sizable stock market crash is coming, and they've been monitoring the risks and taking defensive positions to prevent further losses. If you doubt it, just check the short seller index. In the past month alone, bets that the stock market will crash in 2022 rose 11 basis points, with some sectors, including consumer discretionary and energy stocks, registering the biggest jump in short positions, rising by 74 and 72 basis points, respectively. 15. On the other side of the globe, the outlook is not good either. China, seen as one of the main engines for global economic growth, is facing numerous financial and economic challenges. The collapse of the country's giant property developer Evergrande Real Estate Group is sending shock waves throughout the nation's housing and commercial real estate markets. Real estate accounts for up to a third of China's GDP, and with this important market in turmoil, the Chinese economy is losing strength. On top of that, new virus outbreaks and lockdowns are impacting the production of goods and overseas shipping, which has been sparking severe consequences on global markets and aggravating the ongoing supply chain crisis. China's domestic problems are likely to have a spillover effect on several economies, including the UK and the US, and fuel a full-scale stock market crash as financial conditions continue to worsen across the globe. The signs of a devastating economic and financial collapse are everywhere. It is only a matter of time before we find ourselves in the middle of the worst financial disaster of modern history. And considering the pace at which things are falling apart, we will not have to wait that long.